We got another market review for you today where we analyze the stock market to see whether a correction or crash is coming. And you all know that the market has been absolutely crazy lately, so this review this week is even more important than normal to protect your money. And that's really our job at Fallible, right? Protect your money through risk management while growing it at the same time. So first thing we're going to do in this video is talk about inflation, because that is a big topic that's making the rounds now as we get into this reopening of the economy while we still have all this stimulus from the Fed and the government. So everybody's talking about it. Let's break down what's going on. And then of course we'll move to the stock market to see what's happening there, because lots of volatility, obviously. We also have a few stocks that we're looking at that we're going to go over that you may want to add to your portfolio. And then finally at the end of this video, I got something really important to talk to you about that's going to help you deal with all this volatility, because I've been getting a lot of emails and a lot of comments, so I want to address all that. So let's jump into our research straight from MacroOps, our global macro research and consulting firm. And this one is called Is Inflation Coming? Well, let's look at the charts and see. So in our view of MacroOps, like we've talked about in previous videos, we do expect both growth and inflation to run above the consensus this year. So here's Morgan Stanley kind of summarizing the argument, which we agree with. So as the reopening happens, there's going to be significant price adjustments to mobility linked sectors of inflation. And that's going to come alongside with inflation in actual physical goods, which has already been elevated because inventories and supply chains remain constrained. Same reason why every week I complain about not being able to get a PS5, because they just can't make enough and there's a chip shortage and I got to do this stupid lotto and I never win. But one day I'll tell you that I got one. And not all of these inflation pressures in 2021 are transient, meaning that they'll go away in the sense that they're temporary, because in 2022 this inflation is going to intensify even more because of a tightening labor market and robust levels of demand. So Fed's goal was to bring unemployment down, right? But when you bring it down way low, then what happens is that it gets tight where everyone has a job. So to be able to hire new people, you got to offer even higher wages. So that's wage inflation, while at the same time there's a lot of demand in the economy because of the opening up, and all that demand pushes the price higher of goods because still the supply chains are constrained, right? So you got wage inflation and you have goods inflating too. So continuing with their analysis, a lot of the inflationary pressure will come as the economic activity begins to normalize, things opening up. But then on top of that, you got multiple rounds of fiscal stimulus and excess savings. They provide a powerful tailwind of buying power that has been building among US households, ready to be deployed as the economy is reopening. And I know it's weird to think about that there is excess savings, like people are holding on to a bunch of money because the economy shut down, right? A lot of people lost jobs, but there is indeed built up excess savings. You can see right here, 1.5 trillion in 2020 and 900 billion in 2021. So that is a lot of money that is going to be pushed into the economy all at once, which is why we're going to get this boom. People are ready to spend. One COVID effect on activity has been to shift spending away from services and into goods sectors, which makes sense. When you're under lockdown, you're not getting as many services. As a consequence, in those areas where demand has accelerated, inflation has also accelerated. And this strong demand for goods has also led to lean inventories. So you got demand shooting up, but the actual supply of these goods is going down because of the production problems that we just talked about. So higher demand, lower supply, what's going to happen? Prices are going to shoot up, which is good in the stock market, but when it's actual physical goods, then they call that inflation. And that could be bad if it gets out of control. In addition to everything we talked about, we also got to look at the US dollar, because if the dollar gets weaker, that also causes inflation. And guess what? The dollar is getting weaker. Already, the depreciation in the dollar over the last year has shown up in higher import prices, which will likely pass through the inflationary pipeline into consumer prices as well. So if it costs a company more money in American dollars to buy something overseas so they could bring it to you, they're just going to pass that cost on to you. And the reason it costs them more to buy it is because their dollar is weaker. So $1 equals less euros than it used to, so you have less purchasing power over there. And the impact of the dollar decreasing in strength has a longer tail. It has a long effect. So a simple simulation of the effects of a 10% depreciation in the value of the dollar shows these effects can remain in place for a number of quarters. And you can see that in this graph right here, a 10% dollar shock impact on the core PCE inflation. It lasts for many quarters. So it's no joke. So yes, it does look like inflation is really coming. So what we're going to have to watch is how the Fed deals with it, because they're the ones manipulating the interest rates, right? It's their dual mandate to keep unemployment low, but inflation low too. And what's interesting is that the market is revisiting its Fed policy expectations by pricing in hikes earlier than what the Fed has communicated. So Powell came out and he said we are going to keep interest rates low for longer. He said that for a long time now, right? But the market is doing something different now. They're pricing things as if a hike is coming. And this is creating a communication challenge for Powell. And it will eventually lead to increased market volatility, or it's going to force the Fed to make some changes to its messaging. And this whole thing just becomes such a stupid game. I don't know why our entire economy functions off this weird communication thing. But we do know that the Fed is the most important to watch when it comes to the markets. It's like what the king, Stanley Druckenmiller, said, the most legendary trader. He said earnings don't move the overall market, it's the Federal Reserve Board. Focus on the central banks and focus on the movement of liquidity. Most people in the market are looking for earnings and conventional measures, but it's liquidity that moves markets. So focus on the Fed. Yes, we know that. But not only do we got to focus on the Fed, but also how people are reacting to the Fed. So if Powell says one thing and the market says, no, we don't believe you, well, then you're in a real weird situation, right? And it's not uncommon because this happens all the time. And then the Fed has to change their messaging. And Powell has to come out and say, no, guys, believe me, seriously, this is what we're going to do. Again, it's a stupid game because we can't take what the Fed says as truth. Everybody's trying to play each other back and forth. And that's why this macro stuff gets complicated and markets are complicated. So we're going to have to watch and adjust as things play out. Now let's talk about the stock market and what's going on. Because we saw some crazy volatility last week, especially in tech stocks. And a lot of it was caused by treasuries just falling off a cliff. You can look at treasury bond futures right here. They just keep plummeting, causing rates to go up, which is causing stocks, especially high value tech stocks, to plummet. And we're just getting a lot of whipsaw volatility right now, especially last Friday when in the afternoon the market had a huge face-ripping bullish reversal. And it surprised many people. And we'll talk about that more in a second. But even in our macro ops portfolio, we put a short entry at the literal bottom of the market right before it turned around. So we took a nice hit on that. Fun stuff, as Alex says. Yes, markets are absolutely fun. But this basically gives us a double bottom false breakout. And remember, breakouts can be to the upside, but they could also be to the downside too. So we got that off the lower Bollinger Band on the daily time frame. You can see here the double bottom reversal off the lower Bollinger Band. And that means we should see further upside follow through this week. But if these bonds keep dropping like this, then really anything goes, which is why things can continue to be volatile. But our broader market view is the same as it has been for the last few months. Sentiment and positioning are stretched, which means trend fragility is high. So we should expect more chop and volatility like we've seen over the last few weeks. Because remember, if everyone's positioned super long in the market and everyone's super bullish, that's actually a bearish sign. But right now the market continues to go up, but if you include all that sentiment and positioning, then you know as it's going up, it's still fragile, which is why we're seeing all this crazy volatility. But at the end of the day, the fiscal and economic recovery dominates, so the path of least resistance is up. Because we are reopening, those new stimulus checks were approved, and that is going to push the market higher. Another bullish sign is that hedge funds are starting to pile back into stocks after sitting on the sidelines for much of the last 10 months, which is crazy. You can see overall hedge fund exposure going up. Now, like I said, there are a number of stocks that we're looking at that you may want to add to your portfolio, so let's get into those. First up is precious metals, because if we are seeing above trend inflation coming, then things like gold look pretty good. Now, these things have been hammered over the last 6 months, and currently only 12% of gold miners are trading above their 200-day moving averages. And action this bad tends to precede bottoms. You can see the percentage above the 200-day moving average, it is very low. And if this is marking a bottom, then you should definitely be looking at gold miners right now. But another area we're tracking is semiconductors. They remain incredibly strong, especially considering the broader market action over the past few weeks. They are staying up, which kind of makes sense because with everything I'm reading, it looks like this chip shortage is going to go on for a long time. And these chip makers, they're going to benefit from it. If you remember our older videos, we were talking a lot about DRAM, which is basically a form of memory for computers, so we're still talking about chips here. So we talked about how they hit a bottom in prices for this current cycle. And since then, prices have pretty much gone vertical, and it's really only getting started. And one great stock you could look at to play this DRAM trend is Micron. We've talked about this in previous videos too, but the trend is so strong on this one. Look at it. It's continuing to go. Another thing we like right now is the housing sector. The stock there is CVC, Cavco Industries. At least I think that's how you say it. Maybe it's Cavco. I don't know. But this company produces manufactured homes as well as providing financing. Its chart is looking really good with a 3-year wedge right here. It's breaking out of it. So definitely another one to add to your watch list. Now let's talk about something important, because I've gotten a lot of emails from people over the past week about how stressed they are about the market. And I completely understand, because a lot of people, most people actually got shook. And I'm not just talking about retail traders here, but I'm talking about professionals professionals. So you know, over at Macro Ops, we're connected to some of the best traders in the world, and that's not even an exaggeration. And for a lot of them, including us, the market was doing crazy things that we were getting wrong because it was so volatile. So the first thing I want to say is that if you took a few losses and got shook out of the market recently, don't feel bad. It happened to pretty much everyone. No one was expecting that crazy price movement that we saw, especially that reversal on Friday. In the Fallible system, we took a nice hit as well. There is no doubt about it. Now, of course, it was nothing out of the ordinary because our risk management kicked in as always, but the emotional part of it is still the same. It sucks. That's the funny thing about risk control, is that it almost always hurts in the moment. It sucks. You're like, God, I'm taking this loss. It's probably going to turn around. This is all crap. But the time it feels good is at the end of the year when you're looking back on your P&L and you're like, oh, thank God I followed my stops and my risk management, because that is what actually put me ahead of the market now. But again, in the actual moment, yeah, it sucks. And it's especially crappy when you think about what happened after you sold. Like we were talking about this huge reversal on Friday. Like we got shaken out of most of our positions and then saw this huge reversal on Friday, and now it looks like the market might recover. That's basically the analysis that we went over in this video, right? So of course you're going to feel like, what the heck? I just got thrown out, lost money, and now the market's going to take off without me. It sucks. Well, first I'll say is that we don't actually know what's going to happen, right? It could turn around and go down, and then you're going to be like, oh, thank God I got out. But even if it does rocket off from here, you can't base whether a trade was good or bad off the immediate result. You could only base whether a trade was successful off of whether you were executing your process and your strategy. That's what every professional trader knows. The immediate outcome, you're never going to know. You can't predict it. It doesn't matter. If you execute properly, that's a win, regardless of if you actually made money on the trade or if you lost. And that's what our Fallible members who use our Fallible strategy, they understand that, because the whole strategy comes with psychology training. And part of that psychological training is understanding cycles in the market. Understanding that you could have a row of losers but still be successful because you're executing your strategy. And at the same time where your P&L might go like this, doing the same things you were doing while it was losing and executing your strategy is the same thing that makes you win out in the end. It's all about understanding the full cycle of your strategy and the market, and then remembering to continue to execute and get your emotions in check. And in that training, I have live examples of this happening to me so many times, and it has happened to me so many times, where I'm managing my risk, I'm cutting my positions, the market's falling, I lost money, it all sucks. And then literally a week later, because the market turns around, I made more money than the previous months combined. It just happens over and over again in the market, and that's why people are so bad at trading the market, because it gets so emotional. Even though I've been through it so many times, I still didn't feel great last week. I do my best to completely separate my emotions, but they still affect you. So even when you're getting crushed, you got to keep executing, because that's what's going to secure your P&L for the long term. And I'm telling you, if you've been in this game long enough, you've just seen it so many times. This weekend, multiple people were asking me, hey, what's going to happen with this market? What's going on? And I told them, I was like, the market's going to go up, it's going to go down, then it'll probably go up again, and then after that, I imagine it will likely go down. And it's just because, I'm just detached at this point, because the market is going to do what the market is going to do. And for me, my goal is to avoid the negative emotions that come from the market. I just want to execute my strategy. That's what makes you money. Now, I've gone so far in my detachment that I'm actually not as interested in markets anymore as I once was. It's not the same for me after all these years. And me personally, I was like born into it because my dad was a portfolio manager too. So I had a little head start. And that's why I'm starting this second channel, because it's going to be more fun. But don't worry, we'll still have this channel. And my point in saying that is not to say that you shouldn't be interested in markets, but I think it's just valuable for me to help people have that option, or I should say even that luxury, to not care about the market. And the only way you can do that is if you have a good system backing you up. That way markets become a background thing so that you could focus on whatever you want to do. And if it is markets that you want to focus on constantly all the time, then that's awesome too. You could still have your system running, and I would send you over to Macro Ops, where you could go super deep in this stuff, hit it every day, and then become the next Stan Druckenmiller. So it's up to you for what you want to do. What's your personality? What are your goals? But that doesn't mean we all can't have a system that performs way better than the market, because we can, as long as we can control our emotions and execute properly. So if you felt bad during this time, don't worry, you're doing great. Just keep executing and you're going to come out on top in the end. This is just a normal part of markets, and it's why markets are hard. So control your emotions and execute that system, and we'll all be fine. And if you're not familiar with our system, we do have this free training that teaches you exactly what we do, so you can do it too. I'm going to put a link to this training in this video and down below in the description and comments. Same strategy I use and all our Fallible members use, as I've already mentioned. And now is probably a great time to start using it, because we have a nice drawdown in all these big names where we could get in, and if this market does turn around, well, it's going to look pretty good. So definitely check our system out by going into this training right here. So click this training and I will see you there.